Morning everyone, welcome to Ainsley News. It's Wednesday, the 6th of April. Talking about the RBA today, it turns hawkish. What next for the Aussie dollar? Yesterday's Reserve Bank of Australia meeting marked a clear turning point for the Aussie Central Bank. The same bank that not long ago promised we wouldn't see rate rises for years has been doggedly playing its patience card of maintaining an all-time low cash rate of 0.1% amid the inflationary onslaught and bubble-like housing market. Yesterday, patience was very clearly removed from the narrative. Big Brother, the US Fed Reserve, has long since abandoned its patient transitory inflation position and flipped aggressively to tightening mode. The RBA yesterday flagged that, whilst it will no longer be patient, it is waiting for even more confirmation from key inflation and jobs data. This from them. Over coming months, important additional evidence will be available to the board on both inflation and the evolution of labour costs. With an election in May, the flack they've copped for raising rates during the 2007 election, and the above evidence being inflation data on the 27th of April, wages data on the 18th of May, and national accounts data on the 1st of June, the stage appears to be set for an overdue coiled spring June hike. Despite the not yet message, the clear inference that patience has become soon saw the market react strongly, with the Aussie dollar surging above 76 cents. Aussie priced gold, of course, came off $20 in the same move before reclaiming some of that lost overnight, as a stronger US dollar saw the Aussie dollar back under 76 cents again. The market is also pricing in a much more aggressive move than the RBA as well. This from the AFR. Traders are tipping an 84% chance of a 0.25 percentage point hike in the cash rate in June this year, and nearly even odds for a 0.5% point move, followed by nearly 8 increases to 1.9% by the year's end. Just repeat that. Looking forward to nearly 8 increases to 1.9% by the year's end. Wow. The Australian government 3-year bond yield jumped 16 basis points to 2.48%, and the Australian 10-year yield added 6 basis points to 2.8%, amounting to a curve flattening. So whilst the Aussie yield curve is not inverted like that of the US, this severe flattening in the same journey the US had to get there. And so, to be clear, the country with the world's highest personal debt underpinning a property market that's seen 20% growth in a year is staring down the barrel of a 30-fold increase in rates. One of Australia's most prominent economists sums it up nicely. Here's a tweet from Stephen Kukalis. Market reaction to RBA error in delaying the interest rate hike is now to price in a 3.3% cash rate by late 2023. So plug in 325 BPS of hikes into your mortgage calculator or your business plan debt and see how you feel. Regular readers and listeners will remember Chris Joy's prediction that just a 1% rise could trigger a 25% correction in the property market. The market's predicting 3 times that. The path ahead for the Aussie dollar is very unclear, with many opposing forces. Whilst commodities boom amid the Ukraine conflict, it is certainly bullish for the Aussie dollar, but there are growing fears the recession flagged by the US yield curve inversion will wipe that out. In the meantime, in a world where everything has a denominator pair, the US dollar as the dominant AUD denominator is looking at a Fed now becoming more aggressive in their monetary tightening. Overnight, one of the most dovish and most senior Fed members, Lael Brainard, shocked the market by stating this. The Fed will continue tightening monetary policy methodically through a series of interest rate increases and by starting to reduce the balance sheet at a rapid pace as soon as our May meeting, adding that she expects the balance sheet to shrink considerably more rapidly in the previous recovery, with significantly larger caps and much shorter period to phase in the maximum caps compared with 2017 to 19. So, quantitative tightening sees the actual reverse of QE, and the Fed is a net seller of US Treasuries. However, the US government is issuing new Treasuries hand over fist to fund its deficit spending, ironically to keep the strong market afloat. So who buys all these bonds at sufficient pace to not see yields surge higher? Higher rates generally equals higher US dollar, which puts downward pressure on the Aussie dollar. David Lewin-Smith, chief strategist at the MB Fund, encapsulates the uncertainty ahead. This from him. My own view is that global recession is coming much faster than most think, which will add double the downside to the Aussie dollar as commodities crash and DXY rockets. That said, until the panic emerges in full, the Aussie dollar is clearly biased upwards on Ukraine war commodity price impacts. These extreme opposing forces risk above all greater volatility, and the Aussie dollar outlook takes on the dimensions of a boom and then bust. My base case is this will fully play out in 2022. Make sure, everyone, balance your wealth in an unbalanced world. If you are looking to purchase any bullion today, jump over to anzbullion.com.au. You can also check out any of our news, charts, pricing, etc. through that website. After some crypto, anzwealth.com.au, and our own crypto built and backed by Real Gold and Real Silver, goldsilverstandard.com. Enjoy your midweek, everyone. We'll catch you tomorrow for more news.